Stagflation is back on the agenda. What is stagflation? And here's the stagflation benefactors that you need to watch and consider. My name is Jessica Amir, a market strategist with Moomoo. Thanks for tuning in to the Daily this first day of April 2025. It's great to have your company. Let's just kick off with a quote. The quote is by US Treasury Secretary Scott Bessent. He said the US is going through a detox period and could roll. Now, we need to pause on this because this basically suggests and tells us a lot that the US government is not focused on what is happening to the US economy or the share market right now, but they're very focused on the future and putting America first. And that's why they're focused on Liberation Day, when we are expecting more tariffs plus reciprocal tariffs to come into effect on April 2. That's probably going to hurt, and that's pretty evidenced by the fear gauge, the market's fear gauge that we call the VIX, that's pricked right back up to one of its highest levels that we've seen in a couple of weeks. This basically tells us that institutional investors are bracing for more downside. Basically, we're bracing for stocks to head lower across the year, but it doesn't mean we're not going to see pockets of gold. We'll get to that in a sec. But the fact is that we do have more recession bets increasing. We're seeing investment banks continue to downgrade their outlook for where they see stocks going for the rest of the year. But the narrative is right now is what the US agenda is. It's actually pressuring down bond yields. In theory, that should be good for the stock market, but basically it's not at the moment. But it is pressuring down bond yields, and that is basically good for corporate America, but it's not yet. But here are a couple of things that you need to consider. The first thing is US stocks overnight actually hit fresh lows. So the US stock market ended higher in the day, but it actually in the session, the S&P 500 and the NASDAQ 100, which is the key index that we've been watching, the NASDAQ 100 hit its lowest level since September 11, 2024. Pretty ominous. And that's purely on the back of fear rising, as we suggested, to one of its highest levels in weeks. Now, the thinking is, and my thinking is, that stocks will continue to atrophy. But you're going to see pockets of rallies just like we saw in 2018. But this is going to offer you the opportunity to take profits off the table and brace for darker days ahead. The second thing that I want you to consider is that history tells us that April could provide short-term reprieve. Now, stocks traditionally have done really well in April, because it's obviously the end of quarter, and end of quarter money is put back into the stock market to kick off a brand new quarter. Now, on average, what's happened in April? Well, the S&P 500 has rallied on average 1.3%. The ASX 200 has risen 1.7%. Its second best month of the year, mind you. And gold has traditionally garnered more flows as well in April. Gold traditionally sees one of its best gains of the month, rallying up 1.7% on average in the month. Now, like we're saying, or like I've been saying, this will give you opportunity to take some profits off the table and perhaps strap in for what is going to be a pretty volatile year. The third thing that I want you to consider and pause on is a big one. And I was trying to explain it at the outset, wanted to pause and flesh it out here, and it's the concept of stagflation and bracing for bear market conditions. So why is this talk creeping up now? And why is the stock market simply telling us what is going to do well throughout this year amid slower economic growth? Now, the concept of stagflation is simply that we are getting slower economic growth, inflation is picking up, and employment is falling, i.e. unemployment is rising. Now, this means that gold traditionally does well. And secondly, companies with high repeatable cash flows. Now, today, I don't think the RBA is going to explicitly say that it's heading for stagflation, but the astute investor is exactly going to read between the tea leaves and tell you that they are positioning for stagflation. So the RBA today is probably going to say that the economy is probably going to be headed for slower growth. They're going to basically say they're expecting higher inflation, higher employment. And that's, of course, on the back of tariffs this year. So what are the numbers that you need to consider if you are interested in paying attention to the numbers? So unemployment could rise to 4.2%. CPI inflation's probably going to head back towards the 4% mark. That's not very good for stocks. So inflation tipped to head back to 3.7%. Economic growth, all in all, expected to be 2.1%. Basically, if you've got 2.1% economic growth, you take out inflation, as I was saying, is going to be around 4%. Obviously, your maths is probably better than mine. It means you're left with very little. So the narrative is quite bearish. Basically, does it mean the RBA is going to come to the rescue? No. The futures suggest there's a 35% chance that the RBA could cut rates today. Basically, don't expect the RBA to cut rates. Expect more economic pain to be felt, perhaps economic pain in Australia to pick up in May. And that's when the market does believe the RBA will cut interest rates. There's a 73% chance the RBA will cut rates in May. And then maybe economic pain to again surface in August. And that's why there's another large chance of a rate cut in August. The market thinks 72%. Basically, all this scenario suggests that stagflation assets could continue to do well. And that's exactly what's happening right now on the Australian share market and globally as well, for that matter. So if we think about the Aussie share market, it's actually held up off its lows. We spoke about that yesterday, but it has fallen just on the back of yesterday's pullback. But I do believe the Aussie share market will see some short-term pressure here. But stagflation does bode well for gold. And as we spoke about yesterday, gold is the ultimate safe haven. It's up almost 20% this year at $3,112 an ounce. That's in US dollars, cracking those record all-time highs for the first time in history. Now, this ETF is the best performing ETF on the ASX this year. It's up 35% in 3 months. Pretty cracking stuff. So that's something to consider. Gold does well in stagflation. What else does well in stagflation? So yesterday we spoke about the idea and the notion of high quality companies. What is a high quality company? Good question. I'll answer it. A high quality company is simply a company that's got high repeatable cash flow. So they're able to grow their earnings regardless of what's happening in the economy. And that's why companies such as quality companies do well in stagflation. Obviously, when an economy is slowing, these companies are able to continue to plow through. So here's an example of what's deemed a quality company right now, and it's a defense ETF. So the market is telling us defense ETFs will probably continue to garner large inflows this year. Again, this ETF, it's a Global X Defense Tech ETF. It's up 26% this year. And the reason that this is continuing to do well is because of EU fiscal spending. That's driving defence spending stocks higher that are in this ETF, as well as global defence companies that are in this ETF. Although the US said that they're cutting back on defence spending, it doesn't exactly take away from the narrative that 2% of global economies are spending money on defence each year. Another type of stagflation benefactor is China-facing stocks. So China is continuing to grow its economic growth. It's got one of the fastest economic growth rates this year, and that's expected to continue. And that's why perhaps China is continuing to see upgrades from central banks, or rather investment banks. So this is this ETF that I've put on the screen, or that we've put on the screen, IZZ, is one of the best performing ETFs on the ASX this year. It's actually the 6th best performing ETF. Now, this basically gives investors access to China-facing stocks, and stocks that are in China's stock market. The biggest companies on China's stock market are in this ETF. Companies in this ETF include Tencent, Alibaba, BYD, for example. And we know we've been speaking a lot about it. BYD shares are up 50% this year. Alibaba's up 57%. And you might be expecting China-facing stocks to continue to see further upgrades from investment banks if we see China further boost consumer spending this year. There's so much to consider, a very long one today because we introduced a pretty complex term called stagflation and the stocks and ETFs that you need to consider. For more information, head to the description section of wherever you found this video or podcast. Thanks for your company.